What is up, everybody? Welcome back to another episode of the Cash Flow Chronicles. As always, I'm your host, Shawn King, and today we are going to discuss a question that we get quite frequently around here. I want to make sure we address those questions because I believe that a lot of people have very similar questions. So let's go ahead and get that answered. If you hear a baby laughing in the background, that is my son. That's so funny. He's really laughing it up out there. Alrighty, so the question of the day is, let's say that we're going out there and we're using our policies. We're either, we're either paying off debts. I don't know if you guys can hear that, but he is literally dying out there. I don't know if they're watching stand up comedy or what, but my 8 month old son is having a ball. Makes me happy. So, like I said, let's say we are out there using our policies and we're either paying off debts with our policies or we're investing in receiving returns. So the question is, should I go back and pay my policy loans, or, big or here, should I go and add that money to paid up additions to boost my death benefit and increase my overall cash value? What should I do, Shawn? And that, my friends, is a great question. It's a super common question, and I'm assuming at some point in time you will probably have that question if you haven't already. So, first, let's break down the question. So, if you're new, you know what the heck we're even talking about, because maybe you're like, what's PUA, Shawn? Why do I have to pay back my policy loan, Shawn? What's a policy loan, Shawn? Because I don't know where you're coming in on this episode. I don't know if this is the first episode on infinite banking that you've ever listened to. If it is, I greatly appreciate it. I love the support, but let's catch up a little bit here. So let's go ahead and break this down. So let's start with taking and paying back a policy loan. So that's very basic. That's something that we're going to be doing quite often. So what does that look like and what does that do for you? So as far as taking a loan goes, say that you went into your policy and you requested a portion of your cash value to be deposited into your account because no one wants the company mailing them a check. Nobody's going to be like, hey, you know what? I could get this money in a couple days, direct deposit, or you could snail mail it to me and I'll get it whenever the hell it gets here. So you ask them, go direct deposit some cash, excuse me, some cash into my account. Now remember, just like I said, this system moves at the rate of direct deposit. It's not instant like moving money from your savings account into your checking account. It's going to take a couple business days, so you got to be patient. But let's say that you have 10K in policy loans from the cash value in your infinite bank. So, I mean, let's say that you have taken 10K in policy loans from the cash value in your infinite bank. Now you can spend that 10K on anything that you would like: a vacation, new car, a bunch of other stuff that would add up to equal 10K. I don't know what you want to spend it on, but it's your money and you need it now, so you go spend it. Now let's break down what happens when you decide to play good banker and get ready to pay the money back that you took in a loan. So when you take a loan out of your policy, because you are using the insurance company's money, remember, we don't touch our money. The insurance company is going to charge you interest. So for this example, we're going to call that interest 5%. So that means at the end of the year, if you did not pay a single dime of that $10,000 back, you would owe the life insurance company $500 in interest, if my math is correct, which I made it super easy math, so I know it would be correct. Now pay close attention because this gets missed by some people sometimes, but that $500, that does not benefit your policy in any way. The money that you're paying is not going into your premium to earn you more death benefit and provide you with more cash value. That money goes to the life insurance company for the use of their $10,000 because you are using their money, not your money. Your money doesn't get touched, which means it's still in there, growing and compounding, completely uninterrupted, which is great. That's why we're doing what we're doing here. So let's use an example that you paid back half of that 10K that you took out. And let's say that you do that within the first year of taking that loan. So you paid $5,000 back over that year period of time. Now remember, that $10,000 was going to cost you $500 in interest if you paid nothing back. But simple math says that if you paid $5,000 back, you would only owe $250 at the end of that year. Think about it like this. By paying back that $5,000, you actually just saved yourself $250 because you are going to have to pay that anyways. Now, we teach all of our folks who take loans out that they should at least pay that loan interest back at the end of the year so that amount doesn't compound on you. So if you had that 10K out and that 10K was making you money, if it was in an investment outside of the policy and it was making money for you, there's no reason to pay that 10K back. But what we do want to do is pay the interest back on that 10K. So every year we want to make sure that we pay that $5,000, we want to make sure that we pay that $500 off so that interest doesn't start to compound. Leave the 10K out, have it keep working for you, but we want to pay that interest off. So now I want you guys to think about this. You just paid $5K back into your policy to pay down that $10,000 debt that you have. Where did your $5K go? Where is it right now? If you said it's right back in your policy for you to be able to access and spend again, you, my friends, are correct. Congratulations, you are correct. All you need to do is think about this one thing. This is a glorified savings account. Think about it like that. It's just, your Infinite Bank is just a glorified savings account, which means all the money that you repaid back in your policy, you keep. You get to keep that. Okay. That's a part of our recapture process. Plus, what you've done is you've eliminated, really stumbled over that word, you've eliminated $250 of that $500 bill that you were going to owe at the end of the year. So that's what happens when you repay your policy. Simple as that. Hope you guys are following. Now let's tackle the other side. So people often ask, do I want to repay the policy loan or do I want to add extra PUA? It's a great question. That is a fantastic question. So let's break down exactly what PUA is and how and why you could and would add extra. So one of my mentors, Hannah Kessler, Hannah spelled forward and backwards the same way, likes to use the rocket ship example to help explain this to people. I really like this example too, which is why I'm going to use it. So PUA stands for paid up additions. And you can think about that in terms of a rocket ship. So the PUA on a rocket ship is the booster rockets. And the reason that we would call it the booster rockets is because the booster rockets is what get you up and off the ground quickly and get you launched into space. Same thing goes for the PUA on the policy. The PUA rider, the paid up additions rider, is what gets us our cash in the early years. So when we fund the paid up additions rider, what it does is it gives us high access to cash. I'm talking like 90+%. And that cash, we're able to start using that cash essentially immediately. So that's basically what it is. PUA is the booster rockets on your policy that really launch that thing off the ground and give you that access to cash value that we're looking for early on so that you can go take that money and begin to start banking with it. Now, you might be thinking to yourself, well, Shawn, that sounds great. Early access to cash. I definitely want as much early access to cash as I can get, don't I? Wouldn't I want to put all of my money into the PUA portion of the policy if that was the case, if that was the portion that gave me more access to my cash? And I would say, my friends, that is a great question. And the answer is no. One important thing to understand is that on a rocket ship, what happens to those booster rockets? What happens to the booster rockets on a rocket ship? They get used up. So at some point, they end up falling off. And that's exactly what happens to the PUA. It's not on your policy for the life of the policy. At some point in time, it will fall off. That's why it's so important to structure the policy correctly, because we want to be able to put as much money into this thing as possible for as long as we possibly can. Because remember, it only gets better and better at making you money. So think about it this way. If we're going to go back to that $10,000 example, if you're putting in $10,000 a year at the beginning and you had to split it between the actual rocket ship itself and the rocket boosters, we would probably suggest, depending on your situation, something like a 40-60 split, meaning 40% to the base, aka the base is the rocket itself, the foundational structure, and 60% to the rocket boosters, aka the paid up additions. Now, that's not always going to be the case, again, but I'll tell you, that's a good suggestion. Everybody's policy is very individualized to them, but that's a pretty solid option. So your policy is going to become more and more efficient at making you money as time goes on. Say 30 years from now, your PUA has dropped off because it's done its job in the early days to get you where you need to go. It launched you off the ground very quickly and into space. But now, at this point in time, 30 years later, your policy is extremely efficient. So when you go and you deposit money into your account, into your policy is returning you an additional 3 times the amount that you put in. So if early on you put 10% to the base of your policy, aka the rocket ship's body, and 90% to the PUA or the booster rockets, well, that means out of your 10K, you decided to only put $1,000 to the base. So at this point, 30 years later, all you can put in to that policy is $1,000, and your policy generates 3 times the return in cash. So when you put in your $1,000, you automatically have an additional $3,000 in cash you can spend. Now in your head, you're probably thinking, hey, that sounds pretty good. I put $1,000 in and it gave me back an additional $3,000 that I can spend. I like those numbers. But if you were to split the base and the PUA, 40% base, body of the rocket, 60% PUA, booster rockets, and 30 years later, you could still put in 4,000 instead of 1,000. 40% of 10,000 would be 4,000. Your policy would be returning you an additional $12,000 on top of your deposit. You tell me, would you rather have a machine that when you put in 4,000, it spits you out 12,000 extra, or a machine that limits you to putting in 1,000 and spits out an additional 3,000? I'm going to say the $12,000 option. I think it's pretty obvious that I want to be able to put more money into a machine that's going to print me out more money. So you start to understand why Sir Nelson Nash, the author here of Becoming Your Own Banker, as I hold up this book. If you're watching on YouTube, if you're not watching on YouTube, go subscribe and watch on YouTube. But you understand why he says think long term, because it's not about the here and now. It's about what am I creating in the long run. We're not building a money printing machine overnight. It's going to take time, but once it is built, wouldn't you want the ability to put as much cash as possible into that machine so it spits back out multiples and multiples of what you put in? I think the obvious answer is yes. I'm going to answer for you because obviously we're on a platform where you can't respond to me. The answer is yes, Shawn. Yes, that's exactly what I want. So having a strong foundation, aka the base of your policy, is vital to the longevity of your policy. PUA is great and it's super important, but it is not everything. Now, there are times when someone might do a 10-90 split, 10% of the base, 90% of the PUA, but that's very situational, and we will talk through that if that is you. So if I were going to try and relate this to something that most people are familiar with, I'd tie it to the old story of the tortoise and the hare. So in this scenario, the base is going to be represented by the tortoise and the PUA is going to be represented by the hare. You could take two equally built $100,000 policies, but the only thing that's different is one of them is a 10-90 split, 10 to the base, 90 to the PUA, and the other is a 40-60 split, 40 to the base, 60% to the PUA. And it's only a matter of time before the tortoise, or the 40-60 split, catches the hare, the 10-90 split. Now, the 10-90 might have got off the line quickly and be far ahead at the beginning, but sooner or later, it's going to run out of gas. And that's when, always, the tortoise wins the race. So, think long term. Don't be afraid to capitalize. Gotcha. All right. So, you decide that you want to add more PUA to the policy, which is a great move. We're talking about after your policy is already in place, you want to add some additional PUA. Here's how that works. First things first is you want to make a quick call over to the insurance company, very easy, very nice people to talk to, and ask them, how much am I allowed to dump into my PUA? How much room is there left? Because there is a cap that is going to limit you, so you need to make sure that you are protected in your policy from it becoming a mech. Now, you may not know what a mech means. Not sure if I've talked about it up to this point so far, so I'm going to explain it to you guys really quickly because it's extremely important. So I'm going to explain how the mech came about too, because this is important. And boy, I wish I was around back then. So the reason why the mech is here is because Uncle Sam and the government started to catch on that a lot of these elite and extremely wealthy families were dumping in boatloads of their money into whole life insurance policies. Just like we always tell you guys, the wealthy have been doing this for a while. They understand whole life insurance, the value of whole life insurance, and especially properly structured participating whole life insurance. So these families were thinking to themselves, holy shit, man, I can put all of my money into these policies. It grows uninterrupted, it grows tax-free, and I'm still able to leverage it. Oh, and the government are completely out of my hair. They're not involved in this at all. Well, they were thinking, of course, I want all of my money to be able to grow like this. Yeah, so the government obviously caught on to that because they need their cut, and there's no way you're keeping the government out of making money. So that's when the IRS came in with tax code section 7702 and came down and began essentially to limit the amount of money that you could put into this type of life insurance vehicle. Now, we can discuss more about the limitations, but really what it states is that if you overfund your policy, it will no longer be considered a life insurance policy. It will become a taxable asset. So this is all going to be based on your human life value. So everybody's going to be different. Maybe I, because of what I make, can can qualify to get $2.5 million in death benefit. Okay. Now, maybe Joe down the street can qualify to get $10 million in death benefit. So, the amount that he's going to be able to put in is going to be far different than the amount that I'm going to be able to put in. So it's, again, very individualized. But we don't want these things to become taxable investments because that would really defeat the purpose of what we're trying to do here. But luckily, your insurance company will alert you beforehand if something happens and you are close to hitting the MEC line because you're trying to pay too much money into your policy. So let's say that you don't call in and ask how much room you have to add into your paid up additions, and you trying to send a check in for $12,000, and they alert you and say, Mr. Stevens, you can only put $10,000 in this year. If you put $12,000 in, you're going to hit the MEC line. So what would you like to do? So they'll ask you, and obviously, if you want to go ahead and hit that MEC line and become a taxable asset, then go right ahead. But they're going to have your back, and they're going to make sure that because you started this type of policy, you probably don't want to hit the MEC line. So they'll alert you, and they'll take you through the process and make sure that everything gets done accordingly so you don't hit it. So don't worry about that. It's totally fine. They got your back. All right, let's go ahead and keep moving on here. If you decide to put more paid up additions into your policy, remember in the example, we were talking about taking a loan, paying that loan back, and then paying yourself the additional interest you charged yourself just like the bank would have charged you. So that's what this is all about. You, instead of going to the bank, you took you took a loan from your policy, you went and made a purchase. A normal person who took a loan from a bank would be paying the bank back plus interest. You took a loan from yourself, you're paying yourself back plus interest. So you decide to put in some extra paid up additions, and here's what happens. That extra PUA is going to go in your premium deposit cup. That's cup number 1 if you're familiar with our 3-cup setup episode. If you are not, I'd go back and check out, preferably watch on YouTube, the 3-cup setup episode because it's a very visual illustration. So I think you'd want to watch that. But anyways, the first thing it's going to do, because it does 3 things. When you put money, extra paid up additions in your policy, it does one of 3 things, and it does these 3 things in the same order every single time. Number 1, it's going to purchase you more death benefit. I'm going to use these little cups here right in front of me if you're watching on YouTube. So when you put money into this premium deposit cup number 1, it's going to buy you more death benefit. That's the first thing it does. Number 2, it's going to provide you with more cash value. So anytime you buy more death benefit, remember your cash value is the current equity available of your death benefit. So when you buy more death benefit, more cash value is available, and it's available at a very high clip. Just like I mentioned before, we're talking about 90+%. I've seen far higher, but if you ask me, I like to underpromise and overdeliver. We're talking about 90+%. And number three, the third thing that it's going to do is it's going to help generate a larger dividend. Yes, love a larger dividend. All right, so now that cash is back in there and it's ready for you to use again. So you took that money out, whatever you took out, you paid some of it back in, you paid some here, you paid some there, you paid some to the loan. If you pay back to the loan, that's available. You pay extra to PUA, that's available. So we got cash. It's back in and available to use. So we've talked about paying back your policy loan. Check. We've also talked about adding additional paid up additions to the policy. Again, a policy that is already in force. So now we need to answer the original question, right? And that question was, what should we do? Should we pay back our policy loan or should we add extra PUA? Well, what do you guys think? Yeah, some of you might be asking, well, Shawn, can we do both? And I would say to you, yes, you can. Of course you can. That is the right answer. That's what I'm talking about, my friends. That is how you use your head. And here's exactly how that breaks down. Because I know some people at home are thinking, well, Shawn, I'm going to need money for both of those things, aren't I? I'll need money to pay back the loan. I'm going to need extra money to add to the PUA. Luckily for you, my friends, that is wrong.
That's wrong. Incorrect.
It's incorrect. It's absolutely incorrect. The reason I have those drops is because I do another podcast about parenting. I constantly say that is wrong to my wife when she gives me wrong answers. No, actually, I use the congratulations one a lot. That is correct because she's always right. So anyways, here's how we're going to do just that. I digress. I apologize. Remember, we teach banking. Banking is an action. Banking is a verb. It's the same thing that your conventional, regular, down the street from your house bank does every single day. For example, if you go into the bank down the street from your home and you take a loan, they will, one, make you pay that loan back in full, of course. Definitely ain't getting no free money. And number two, they will make you add extra PUA, interest, into their pockets. They make you do both from the very get-go. If you've ever gone and let's say just purchased a car, took a loan, got a loan from a bank, they're going to say, hey, Mr. White, we're going to need all that money back that you gave us or that we gave you. And we're going to need some extra. And when you start paying that money back to us, a portion of that is going to go towards the money you owe us. A portion of that is going to go towards paying the interest that you owe us, which is why when you buy a $10,000 car, you end up paying over a period of time, probably like $15,000 for that car because that interest stacked on top of your original $10,000 amount. And I'm going to blow your guys' mind here. Here we go. Hold on. We're just going to copy that exact process. We're just going to copy what this extremely successful financial institution does. And I promise you, it's going to work out the exact same for you as it does for them. It's as simple as that. I don't want you to complicate it any more than it has to be. You're going to take your normal payment you would have been making, and you're going to pay back some of your loan with it. And you're going to take some of it, and you're going to add it to paid up additions. Now, you can be the one that decides what that amount is. You already know based on the amount of the loan that you took out, so we'll use that $10,000 example again, you already know in that year's time, the absolute maximum you are going to owe in interest is what? Is $500. So if in your mind you're thinking, man, I can handle that $500 interest payment, but maybe I'd like to knock that down a little bit, and you start paying some of that back, you can figure to yourself, all right, well, out of every payment I make back to myself, I want to take 50% of it and pay it to the loan, and 50% of it and pay it to my paid up additions. Doesn't have to be 50-50. It can be 10-90. It can be 40-60. It can be any of those numbers that you want to use. It could be 1288. Is that right? Yeah, 1288, whatever it is. You can make that up, but you get to decide how that money is split when you pay it back to yourself. Sounds pretty simple, right? Well, it is. And if you're thinking to yourself, Shawn, I've done this with my bank, but I've never done it with a life insurance policy. How in the world am I supposed to know what to do? And I would tell you, don't worry about it. We'll walk you through the whole process. It's extremely short and very simple. And we'll do it with you the first couple times until you're a pro. But honestly, because you're deciding to even partake in infinite banking, I'm going to assume that you're probably pretty intelligent. So I would imagine you probably pick it up right away. All we're doing is teaching you how to bank, except this time it's private. So instead of them making all of that money off of you, you're going to be making all of that money off of yourself. So by all means, if you want to go ahead and take advantage of yourself and charge yourself whatever you want because you're in control, just remember, if you play good banker, soon enough, you'll have a money printing machine at your disposal. And that, my friends, is infinite banking. And what I would suggest when you ask, should I pay back my loan or add extra PUA? Well, my friends, that is the episode. As always, I'm going to leave you guys with a quote of the week that I think ties in nicely to the episode this week. It is by one of my absolute favorites, one of the best money mentors out there, Mr. Robert Kiyosaki. And the quote reads, "It's not about how much money you make, but about how much money you keep." I hope y'all enjoyed the episode. If you, hopefully you learned something useful today. That's always the goal with this podcast. If you haven't already, please go and subscribe. Do me a huge favor and rate and review the podcast. I would be forever grateful. Thank you so much. I highly appreciate that. If you want to chat about becoming your own banker and how that might be useful in your life, please don't hesitate to reach out and schedule a call. My information is in the notes section below. The website is legacylifeandretirement.com. You can go there. I appreciate you guys tuning in. And as always, the information is free, but the knowledge is priceless. Catch you guys next week. Peace.